Hello, we are Group 2. Today we are going to present question 15. Here are some background information for this question. Ryan and Ryan's wife, Rebecca, both of them have their own job. The question asks us to compute the Hong Kong salary tax liability of them using the most advantageous basis of assessment. So the thing we should consider is that should they elect for joint assessment? That means whether they can save the tax from electing for joint assessment. For Note 1, he received an annual salary and commission income. Firstly, we should identify the source of income. Under the IPN 10, there are three criteria of identifying the source of income. In this case, Ryan is having a Hong Kong source employment. And under Section A1A, if employment is fundamentally sourced in Hong Kong, basically all income is accessible. So the $360,000 and $270,000 are fully taxable. For Note 2, he lists a flat at a monthly rent of $15,000 and obtained a refund of $12,000 from Centenary. So this is a case of accommodation at subsidized rent, since it is a place of residence is provided by the employer, and the employer has partially refunded the rent paid by employee. The taxable amount is equal to rental value less rent paid by the employee. And rent paid or refund by employer is not taxable, so the refund of $12,000 from Centenary is not taxable. Then we can calculate the rental value and taxable amount of this case under Section 9.2. There is no reduction of taxable rate because the residence is a flat instead of hotel. The rental value is $56,400. The rent paid by employee is $36,000. So the taxable amount is $20,400. Nextly, he engaged a domestic helper at a cost of $5,000 per month. Centenary paid the helper's salary on Ryan's behalf by depositing the salary into helper's bank account directly. So in this case, it is a fringe benefit since it represents a discharge by the employer of a personal liability of the employee. So full value of the liability need to be assessed. And there is an exemption under Section 9184 if the relevant payment is one for which the employer has a sole and primary liability, and no person was a surety. But in this case, Ryan engaged the domestic helper by himself. So that means employee himself signed a contract with the domestic helper, so there is no exemption. And the domestic helper is not work for the company. The employer paying salary of employee's private domestic helper which the employee himself had incurred. So the $5,000 per month is fully accessible. For Note 4, he was requested by the company to join a social club and paid annual subscription of $6,000 and received a full refund from Centenary. Under Section 12.1a, the outgoing and expense is deductible if it is necessary and in the production of accessible income in the performance of the duties. But in this case, Ryan was requested to join a social club. The subscription fee is not deductible, since it is not necessary for the performance of duties. And so that the refund of $6,000 from Centenary was fully taxable. For Note 5, he purchased a car at a cost of $250,000 and paid petrol, insurance, and license fee totaling $40,000 for the whole year. And the business use portion of the car was 60%. The depreciation allowance of the car was calculated to be $180,000. They are not refunded by Centenary. So for petrol, insurance, and license fee, the $40,000 amount under Section 12.1a, it only can be deducted if Ryan spent it necessarily and in the performance of the duties. And the notes mention that 60% of the car use is business use, so which is deductible. So after times 60% of the total amount, there's $24,000 of petrol insurance and license fee can be deducted. And for the depreciation allowance, the $180,000, it only can be deducted if it is essential to the production of accessible income. And as the same with petrol insurance and license fee, times the 60% is deductible. So after times 60%, there is the deductible amount is $108,000.
Note 6 is related to share-based benefits. Under Section 91D, obtained by employee or office holder, share-based benefit is a taxable benefit. The taxable amount will be the gains realized upon exercise, assignment, or release of the share option. On the 1st of June, there is no taxable amount, as Ryan only granted and without gaining from exercise, assignment, or release. On the 2nd of August, the taxable gains by assignment or release would be calculated by the amount received minus the cost of the share or option. As the question didn't mention about the cost, so we assume it is zero. So we get the taxable gains by assignment or release by $200,000. On the 3rd of November, Ryan exercised the remaining shares, which is 20,000, and the taxable gains by exercise would be calculated by the market value of shares on the date of exercise minus the amount given for the shares and options, where we can get $160,000. And after exercising the shares and options, subsequent gains or loss from the share is not taxable or allowable. So, shares subsequently sold are irrelevant for the taxable or allowable income. As for Note 7, under Section 26G, the deduction of contributions to Mandatory Provident Fund scheme is the mandatory contributions made by the employee. Maximum deductions from the year of assessment 2015 to 16 onwards would be $18,000. Ryan made mandatory contributions of $18,000, which does not exceed the maximum amount and could be fully deducted. Under Section 26S, effective from the year of assessment 2019 to 20, deduction is allowed for the tax-deductible MPF voluntary contributions. Under Section 26U, total deduction allowable to a taxpayer in respect of qualifying annuity premiums and tax-deductible MPF voluntary contributions cannot exceed $60,000 for a year of assessment. As a result, the $20,000 could be fully deducted. Under Section 121E, self-education expenses are the expenses paid by the taxpayer as the fees in connecting with a prescribed course of education or fees in respect of examination. Prescribed course of education is defined as a course undertaken to gain or maintain qualifications for use in employment, and we exclude the allowed deduction under other provision or reimbursed by others, unless the reimbursement is taxable. Ryan paid a tuition fee of $40,000, and he enrolled in a degree in marketing at PolyU, which is a prescribed course of education, and we exclude the allowed deduction by other parties of $10,000, and the total deductions will be $30,000. Under Section 26C, approved charitable donations should fulfill the following requirements, including the donation should be in form of money and should donate to any approved charitable institutions or trusts of a public character or to the government. And for charitable purpose, it should be a voluntarily gift without variable consideration, which means that which should not donate for purpose and should not receive something in return. The Hong Kong Polytechnic University and Red Cross are the trusts of a public character and approved charitable institution respectively. However, Ryan donated $10,000 to Red Cross and was given 2 tickets to a charity show by Red Cross, where donation could not be formed, which is similar to the case of Sanford Young Tao Young versus CIR in 1977, where inflated price paid to a charity for tickets to a social event does not constitute a donation. So we only take the $25,000 to Poly U into account as donation. Note 10 is similar to Note 7, and as 3,500 does not exceed the maximum amount, so it could be fully deducted.
Note 11. Ryan and Rebecca have a son, age 15. Ryan's parents, age 65 and 58, are residing in Hong Kong. Ryan paid them $5,000 per month as their living expense. Under Section 31, child allowance is granted if a person had living and was maintaining at any time during the year of assessment an unmarried child who was under the age of 18. In this case, Ryan and Rebecca have one son only, who is 15 years old. Therefore, child allowance is granted with the amount of $120,000. Under Section 30, dependent parent allowance is granted if the person or his or her spouse who is not living apart maintains his or her or spouse parent who is ordinary resident in Hong Kong and age 55 or above. Allowance is granted for each maintained parent and it is given to one person only. One of the meaning of maintain is that the person or spouse contributes not less than $12,000 per year in money towards the maintenance of parent. In this case, both parent age above 55 and reside in Hong Kong. Ryan contributed $5,000 per month, and which is $60,000 per year. Therefore, the dependent parent allowance is granted. The amount for parent age 65 and 58 is $50,000 and $25,000 respectively. Note 12. Ryan has purchased voluntary health insurance scheme policy and paid qualifying premium for himself, Rebecca, and their son in the amounts of $10,000, $8,000, and $3,000 respectively during the year. Under Section 26K, effective from the year of assessment 2019 to 20, deduction is allowed for qualifying premiums paid by a taxpayer or his or her spouse as a policyholder of a voluntary health insurance scheme policy that is certified by the Secretary for Food and Health for an insured person. The insured person must be taxpayer or his or her specified relative in the year of assessment, and must be a Hong Kong ID card holder at any time during the year of assessment. A specified relative means an individual who is the taxpayer's spouse or child and the taxpayer's or the spouse parents, grandparents, or siblings. Maximum deduction allowable for each insured person is $8,000. In this case, the insured person is Ryan, Rebecca, and the son. They are the taxpayer and the specified relatives. The son age 15, which is under 18. Therefore, deduction allowable for them is $8,000, $8,000, and $3,000 respectively. There is a total deduction allowable of $19,000. Note 13. He also purchased a qualifying deferred annuity policy with himself as an annuitant. He paid qualifying annuity premiums of $30,000. Under Section 26O, effective from the year of assessment 2000. Answering the question raised by my teammate in the introduction part, whether Ryan and Rebecca should elect a joint assessment, the answer is yes. Here are the computations of tax payable by the method of joint assessment and separate taxation, where joint assessment is on the left and separate taxation is on the right. It shows that tax payable is $31,683 and $42,233 respectively. Therefore, it will be tax efficient to elect the joint assessment. Under Section 29, married person's allowance is granted if person is at any time during the year of assessment is married, and joint assessment is elected. Also note that no person may be granted both basic allowance and married person's allowance. In this case, Ryan and Rebecca is husband and wife. Therefore, married person's allowance is granted to Ryan with the amount of $264,000. Gathering the analysis by my teammate and I, here's a computation of salary tax liability for Ryan and Rebecca by the joint assessment. The salary tax liability is $31,683. This is the end of our presentation of question 15. Thank you.